Good afternoon, everyone. Welcome to another edition of our weekly Wednesday webinar. My name is Stock Darts. You can find me on Twitter at Stock Darts or YouTube under the same name. And you can also go to patreon.com/StockDarts if you're looking for any more information or any more trades, or even just any kind of content that I post. I put a lot of stuff on there like watch list ideas and trading ideas. Frank's feeling a little bit under the weather, so we will not be seeing Stock Guy 22 today. But if you want to follow him and see when he posts new stuff, you can always find him on Twitter, YouTube under the same name as well. We're going to do the usual. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we will take a look at the U.S. dollar. We'll see how it's faring. We'll see how how it's doing versus the euro, the Canadian, and the Japanese yen, and then we'll take a look at gold, silver, and oil and how they are being affected, if at all, by the U.S. dollar and its fluctuations. Once we finish with that, we'll take a look at chart requests. If any of you guys have chart requests, those of you that are in here early, feel free to put them in now. That way I get an idea of what we are looking for. Other than that, we can go ahead and get started with a look at the SPY ETF, which of course is representative of the S&P 500. And you can see that this week we finally are seeing some red candles. This is something that I've been looking for and anticipating in the markets for a couple of weeks now. And interestingly enough, Monday, we had a nice, what was becoming a bullish engulfing candle. It turned into kind of this big hammer. But a hammer at the top of a range is not necessarily a good sign because it shows that there was a lot of selling pressure, even if it ends up closing up on the day, or at least above, well above the lows of the day. But with the fade that we've had the last 2 days, I do think that there is more downside coming in the markets. We will see that IWM has already started to pull back, and frankly, it's something that I've been waiting for and anticipating and hoping we get a bit more than what we've seen so far. Now, the issue, of course, is that there has been an incredible amount of demand underneath the surface of this market, and that's why we've had this straight climb up, right? Because we can't find sellers, and every time there's even the inkling of a drop, sellers come in or buyers come in right away, step in and try to buy and try to get any kind of a discount they can. And what we've ended up doing is just sort of rallying and running straight up into resistance. Like I said a couple of weeks ago, I expect this to be very stiff resistance. I expect it to be a very difficult climb for the markets to get past the levels they're at right now. And as you can see on the S&P 500, we've really started to struggle here. We've had two candles up here that attempted to break out and have instead turned into red candles that eventually put us right back below that level. And of course, that key level is 280 on the S&P 500 or on SPY. And if you look back and really pay attention to what we did last year, you can see that we had that really nice climb up to all-time highs. And then once we started to break down in October, we tried to base out. And we made this nice broad range base or channel, and the top of that channel was 280. That became a significant area from which we ultimately broke down towards the end of the last year and really sort of plummeted. And we've made our way all the way back up to that area. And the problem here is if we can push past 280, well, then all-time highs are really right around the corner, right? So the question you have to ask yourself, and the question that bulls are asking themselves right now is, are we ready to move back to all-time highs? Are we in the same place right now that we felt we were last year in August and September? And I think the short answer is no. And not saying we can't test those highs anywhere near in the next few months, but I think for now it's very difficult for any kind of equity to go from being at really precarious lows and then just make a beeline straight for all-time highs. And cut through basically an entire year of actions. If we go back and we just take a look at what happened here throughout 2018, you can see we spent almost the entirety of 2018 trading in a range between about 258 and really about 292, right? And what we did at the end of last year is we sliced all the way from the very top of that range all the way through and well below and beyond those lows, right? And what we've done this year is almost erase that entire drop in one move with no real pullback, no real sort of consolidation range other than these temporary little bull flags. And it would be beyond impressive to be able to just slice all the way back to all-time highs. And for the most part, not only recover an entire year's worth of price action, but more than that, we're talking a year and a half, almost 2 years of price action, if we come all the way back here and take a look at where we were, that's basically February of 2017, and we were trading down at that price, and then all of a sudden 2 months later, we are almost all the way back to basically what took us 2 years to climb in an incredible bull market, right? That's the thing that's really impressive about this, is that the market that we had in 2017 was quite a bull market, and it was just an impressive market that never really corrected and traded and just stair-stepped its way higher. And we had this big rollover and came down to a pretty good part of it, and we've recovered the entirety of that and the majority of what we spent last year in one swift move, right? So it's been very, very impressive. A lot of traders still doubt it, and that's part of the reason why we continue to climb higher. But the issue is, of course, that sooner or later these sorts of surges in momentum, they get tired, right? They tire out because, of course, sooner or later you run out of buyers. And I think we finally have found some sellers, which again is something that we've been looking for and anticipating in these Wednesday webinars for the last 2 or 3 weeks, right? And why I've been hesitant to really go long too much and get too aggressive playing to the long side is because we've reached a point now where the market probably needs to pull back and reset. Now, the question that I often get in these situations is, well, if you expect the market to pull back, shouldn't we be selling here? Shouldn't we be taking short plays? And I don't think that's really the right place for it. And the reason for that is that the market is still up. There's still sentiment is still overwhelmingly to the bullish side or to the long side. And as we can see, even with Monday, we had a lot of selling, but ultimately it was bought up at the end of the day because there's still a lot of bulls here that are trying to buy. And so what happens here is, if you think that the market's going down, but it's in a strong bull market, you're better off just waiting and then buying that dip and playing to the long side and playing to the side that the market is favoring. Because what ends up happening a lot of times is, if the market does pull back, a lot of times it sort of staggers and it goes back and forth because there's a lot of buyers that are still stepping in. And so what happens is, even if the market does go down, it's not a clean trade. And a lot of times you get shaken out of it and you get faked out and you end up losing not just money, but a lot of confidence in yourself and in your trading, because emotionally it's much more difficult to go against the grain and to sort of trade against the current that the market's flowing in. So what I'm doing right now is I'm still looking at long plays, obviously, but I'm not looking for as many as I would be once we finally pull back and set up a nice consolidation range. We had much better opportunities earlier in the year to take advantage of this upward momentum, but I think that we've reached a point now where we need to sort of step back a bit and wait for this to sort of stabilize and give us a new consolidation range with better risk reward than what we're seeing right now. We went over the levels last week, but we'll look at them again. If you're looking at the S&P 500, clearly if 280 is a resistance level, that doesn't mean we can't break past it, and we are beginning to establish a tight range around it, right? So the first thing that may or may not happen is that we just print another bull flag, and we still haven't really tested the 20-pair moving average, which we're coming up into right now. Momentum still clearly to the upside. There's still sentiment is still very strong, and if the buyers continue to step up like they've done all year, well, we may not get the drop that we're looking for. What we might end up getting is a nice consolidation range right around the 280 level, and then we just go ahead and push past it, right? So this is the first level. I don't think it's a level that I'd be that excited about if we just did that, because again, I'd like to see more value. I'd like to see us drop a little bit further and get better pricing than what we're getting right now. But the market doesn't just give us what we want, right? So if we want to go ahead and outline potential scenarios, the first scenario we want to look at is the one with the least selling involved, which would be this one. And what we can end up doing is just consolidating around this range, and then once we have decisively broken past 280, we could look for a move past these recent highs around 281, and we're likely going to head up all the way to 286. And again, I don't think that we should be hitting all-time highs, but it's not really up to my opinion, right? The market does what it wants, and it may or may not hit them. But what I'm anticipating right now is, if we can get above 280, well, then I think the sky's the limit, and we might as well take advantage of the long play once it gets back above there. Now you'll notice that I put a couple little trend lines here, right? The key level is 280, but we've topped out twice at 281, so it becomes a tricky spot here to play to the long side, which is another reason why I'm looking for a further drop to get a much clearer trade. Because what ends up happening here is really once we break 280, we should be able to break 281, but it might stall out at that level now that that's become sort of a short-term area of resistance and distribution. So it's not a very clear spot where we'd want to go ahead and enter long on a breakout, which is why, again, I'm favoring a different type of consolidation range than what we're seeing right now. But that is the first scenario that we need to look at, because there's a very real possibility that we don't get any more selling than this. Now, personally, I think we probably do get a bit more selling than this, and if we do, well, the next step is just below there again, which is right around the 200 period moving average. And what happens oftentimes is if you hit the 200, you shake a little bit below there, and then turn around and start trying to climb higher. If that happens, it's really the same scenario as the one I just outlined, just a little bit wider. And what we would hope for in that situation is that we get something like this, where we get a little bit better risk reward, even if it's below the 280 level. And again, that still makes it a tricky trade, right? Because we're still trading, or we're still going long with a ceiling right above us that could probably go ahead and reject that trade right away. So we would need really good risk reward where we can go ahead and take profits, at least partial profits at 280, and then hold for a move past that. That's not really the scenario I'm looking for either, but that would be the next step. Now, beyond that, we would come all the way down to about 269. And I think at this point, I'll get rid of that. And what I'll say is that there's a nice little cushion here, somewhere in this area. And that would be a great buying opportunity. Now, that may or may not happen. That's a long way to drop. That's a long way to retrace when we haven't really had any kind of selling pressure whatsoever. So that may not happen. I suspect that we're probably going to get a more shallow pullback than this. But if we did get to this level, this would be the area that I'd be looking at as far as really getting a lot of charts reset and a lot more bullish opportunities in the market. Now, if we fell below there and we started trading between 263 and 259, then we'd have to worry, because that would be putting us right back to the more substantial lows of last year. Now, of course, the lows of last year were way down at 234, but the majority of the price action used 258 as a floor. And if we started to lose 258, well then, more likely than not, we're going to go ahead and re-challenge some of these lows. So we don't want to really be back down in this area, and especially below it. What we want to do is try to find a good buying area somewhere in here. But the market may not give that to us. What it might end up giving us is, again, just to move back to the 200 period moving average, maybe even just the 20. And then from there, it's a matter of us finding a good consolidation range that gives us a better setup and gives us better timing on a trade. Right now, there's just not a lot of clarity as to how we would go ahead and trade here, which is why I'm, again, hesitant to go ahead and trade too much. And I'm really just kind of waiting for a better scenario on the markets. Now, if we do break out immediately, let's say tomorrow we have a big green candle and we break out, then, like I said, I'm not that excited about trading this, although I would probably take advantage of the momentum a little bit, because we have gotten some consolidation. We have spent now about 2 weeks trading below 280, and if you look at what we've done this year, typically we consolidate for about a week, week and a half, and then we move higher, right? We had that one, we traded sideways there, traded sideways there, traded sideways there, and we're doing the same thing now. Now, this one's a little bit more extended, but it could be that we just follow this pattern and we continue to trade to the upside. So if, again, as I said earlier, if we clear this area here around just above 280, well, then you have to go ahead and take some plays to the long side, because the market is continuing to climb higher. And at that point, really all-time highs again come into play. For those of you that maybe are new here, I think for the most part, most of you guys are regulars. I'm not necessarily advocating trading SPY in this situation, right? When we look at the markets, we're just trying to gauge what type of environment we're in and what type of trades we should be looking at, right? So when we look at this, I'm not saying that I'm going to go ahead and trade SPY to the long side, but if SPY and some of these other indices start to break towards new highs, well, then there should be a lot of names mimicking this pattern, and if they give us better risk reward, they give us a better setup, then I'll go ahead and take a play in those names rather than just the S&P 500. But that's what I'm looking at right now, and it's interesting because right now this looks a little bit bearish. But what I've noticed when I was scanning through a lot of charts this week is that a lot of charts sort of started correcting ahead of the market and are already looking like they want to establish moves back to the upside and maybe get ahead of the curve here and push higher. So that's where we stand right now with the S&P 500. Again, I think what I'd like to see is a bit more consolidation, a bit more of a pullback, but we may or may not get that. And so what we need to be doing right now is being vigilant about what the market is doing and just watching for what this consolidation range is going to how it's going to play out and where we could eventually get an entry trigger or an entry signal. And again, I don't think right now we have an entry signal. I think right now this is a messy pattern. One more thing I want to point out is that we are starting to lose momentum, right? So this is another thing that's telling us we're probably going to pull back further, but I want to be ready for either scenario, whether we pull back into those levels I just pointed out, or if we go ahead and turn around and try to push to the upside. Like I said, be wary of a move to the upside until it's clearly established above 280, because a lot of times what happens here is once you lose that momentum, you get a little bit of a pullback, right? And then you come up, and when you try to bounce, you fail just at that breakdown point, and then from there, that's when you start to head a bit lower, right? So that is the more likely scenario is how it's going to play out, whether it happens at the 200 or what happens below it. But what we want to see again is we want to see a clearly defined range of consolidation, at which point we should have an easy to define trigger as far as playing to the long side once we think that we found a confirmation of support, whether it be at the 200 pair moving average, whether it be at the middle of this channel, or even all the way at the bottom of the channel. Now, if we look at the NASDAQ, we see an interesting pattern. The NASDAQ over the last few days has actually been slightly stronger than the other indices. There's been a little bit more relative strength. And we had this rising wedge, and we had an attempt at a breakdown of it, but that ultimately failed, and we had a nice attempt at a move higher. Now, we have that same hammer at highs that we saw in the S&P 500, and that's not a bullish pattern. For those of you that are, I think most of you guys are regulars, so you probably know this already, but for those of you that are newer or aren't aware, one of the first sort of cliches you hear about when you're looking at candles and trading is a hammer candle is bullish, and it's true at the bottom of a range. It's not true at the top of the range, and that's one thing that's important is understanding the context when you're trying to read price action. A lot of times what you see as far as how price action is behaving, it matters whether it's happening at the bottom of a range, at the top of a range, at the beginning of a move, at the end of a move. And when you see a hammer candle towards the end of a move or towards the top of a range, that's not a bullish candle anymore. That's actually a bearish candle. And the reason for that is because it's showing you that there's a lot of selling pressure, even if it's only the initial impulse of the day, right? Because again, the market was pushed down to newer lows, and then while it did end up recovering at the end of at the end of Monday, it still showed that there's a lot more sellers coming in than maybe there were before. And so what happens now is you have to watch and see how this plays out and whether those sellers sort of return. And you can see today that they are returning, and we're starting to get a push back into the lower half of that candle from Monday. And what we need to see now is a push below the lows from Monday and below the 200 pair moving average, below the 20 pair moving average. Now, a lot like the S&P 500, we may not get that, even though it's what I'm hoping for. You take a look at it. We've got a lot of support here. There's actually a pretty clear, well, I'm going to, rather than do this, I'm going to extend the previous trend line. Right? You can see there's a lot of support here, right around the 200, right around the 20, and just below it around 171. This is the initial area that we will likely pull back and find some early support. Now, it could be that we get a scenario a lot like what I just pointed out in the S&P 500, where we come to this level, bounce, and then try to recover past this area and fail, and then maybe break down, right? So we need to watch for that. If this 171 to 172 area ends up holding as support, well, then what we want to see is it establish a pattern, something like it's already starting to do, where we get a clear trend line or a clear signal telling us that we can start playing to the long side. And then from there, we'd have a nice trade maybe in a week and a half or 2 weeks, right? Once we come back and retest, and maybe early next week to the middle of next week, we would hopefully get a clean breakout somewhere around 172, 173. And that would be a lot easier to trade than if this were to try to break higher now, or if it were to really come down and start moving down to the 160. So this would be the easiest and cleanest trade to happen for us. Again, the market's not going to necessarily cooperate, but that would be the scenario that I would like to point out as far as what I would hope would happen the most as far as the Qs are concerned. Because they've been relatively strong, there's a higher probability chance, or higher likelihood that this area holds for them, even if we dip a bit lower on the S&P 500. If we do drop lower, I think the next level is pretty clear. It's down here at 166, and I really wouldn't want to see the Qs fall below here. The reason for that is if we fall below there, then we start to maybe fall back into this channel that we spent the last quarter of 2018 trading down on, and we would also sort of establish this as maybe a failed breakout, this breakout above 166 as we broke out of that channel. I'm going to get rid of this. We're getting quite a few trend lines on this chart, so I'm going to probably have to delete some over the next week or so. But anyway, that's what I'm looking at right here. Is we don't want to lose 166. If we do drop down to 166, that's still a pretty good buying opportunity with targets all the way back up at 175 and then possibly beyond. But more likely than not, what we're going to get, at least from here to next week, is probably we test this area around 172, 171. And then from there, if we can get a clear pattern that gives us a good entry, then that might be a good place to go ahead and take a look at along. I'll probably have a post on Patreon in the next couple of days looking at some tech names that are, again, acting rather bullish and looking like they want to lead the market higher right now. Despite the fact that I'm expecting a pullback, these tech names are making me think that maybe the market still has another trick up its sleeve and it's going to try to run higher before it really pulls back. But for now, we just have to watch what these indices are doing. And again, I think if we do surge higher here, the Nasdaq, unlike the S&P 500, there is still another clear level of resistance that we have not hit yet, which is right around 178. So we can hit 178 and then from there pull back and still technically not really be a little bit ready for all-time highs. I think that this is the key level that we need to break past in order to start testing highs. And we're not there yet. We still have room to go there. And it might be that the Nasdaq tries to get to that level before we get a stronger pullback across the board on the markets. Now, if we move over to the Dow Jones and the DIA, you can see again, very similar to the very similar to the Nasdaq. We broke past the descending channel. Now we have lost more ground, right? You can see if we look at that hammer candle, this one isn't even really a hammer that we printed on Monday. We're already kind of at the lows, right? So the Dow Jones is behaving a little bit weaker than the Nasdaq, and it needs to come down and probably retest here. And that would be analogous to what we just pointed out on the Qs. If we fell below there, we still have the 200 pair moving average, which would be fine. You can see the Dow Jones actually was, relatively speaking, stronger over the last month, even though it's getting weaker now. In the longer term, it's already well past its 200 pair moving average, and there's a big gap there between the 20 and the 200. So it has more room to pull back and still be healthy. And I think, again, what the most bullish scenario on the Dow Jones right now is that we just stay above this descending trend line and we don't start to lose this area in here. As long as we stay above there, I think that this is still a pretty bullish spot. And as long as we don't lose maybe here, we really shouldn't worry too much. Again, if we put back down to here, this is a little bit more worrisome. If we were trading around 243, 244, because that would mean that we failed that breakout. And I think that at some point this year we probably will test that range. But for now, with the strong momentum that we're seeing, what we want to do is, again, look for an opportunity to buy this dip, and as you can see, the Dow Jones has already dipped, right? While the S&P 500, we haven't really gotten a substantial dip. We're just starting to pull back a bit, and the same thing with the Qs. The Dow Jones has already pulled back a decent amount from 261 all the way to 256, and a little bit more, and we should get a nice value level, and then from there it's a matter of waiting for support to be confirmed and to start looking for patterns that we can identify and trust as far as playing to the long side. Everything else that I've mentioned, or that I mentioned with the S&P 500, the Nasdaq, it kind of is valid also for the Dow Jones. So there's not really much more I want to add as far as this chart's concerned. And the last one we want to look at is the small caps, which I think are the ones that are the most different. And that is because, again, the pattern we've pointed out over the last year, even the last 2 years in this market, and again the small caps are starting to show it again, is that for the most part, traders have had a reluctance to really trust this market. And I think that's part of the reason why the market has been so strong over the last almost decade now, is because there hasn't been this widespread agreement where everyone just gets bullish and sort of sticks their head in the sand and just buys everything. We still have a lot of traders that are constantly fearful and distrustful of this market. And one of the clearest manifestations of that is how the small caps always go down first because they're the most volatile assets, and they're the ones that tend to behave the best when the market goes up, but tend to behave the worst when the market goes down. And what we're seeing right now, again, is the first place that traders want to abandon, the first assets they want to abandon, is the small caps and the components of IWM. And you can see, again, if you look at Monday's price action, we opened today at the lows and broke way below there and are already coming down to retest the breakout of this descending trend line that we have on 3 of the 4 market indices, right? So clearly IWM is leading the way lower. They are still the index that I find to be the one I use the least as far as trying to gauge what the rest of the markets are doing. It's important to see, and they are typically the first ones to go down, and if you're day trading, it's a good idea to watch whether they're behaving strongly or poorly, right? Because if they're behaving poorly, there's probably more of a chance that it's going to be a day to go ahead and sell pops instead of buying dips. And right now, they've broken the 20-period moving average. And again, I think they're broadcasting that the market wants to pull back a bit more. And what we want to see is, of course, we want to see them hold above 152. But because of the general weakness in the way that they've behaved when we pull back in the markets, there's a good chance that they will drop below this trend line. And I don't think it won't really erode my confidence in the other 3 charts. I'd rather see how those other 3 charts, the SPY, the Qs, and the DIA, I'd rather see how they do at support rather than maybe sort of mistrust them earlier just because the IWM broke below its key support. So I want to watch them. Obviously, I'm still watching, and I want to see them hold at support. But if they fail support, that doesn't mean that I'm going to start not looking at buying the dip on any of the other, any other equities across the board just because, the small caps started to lose support. I'd rather still look at what SPY, the Qs, and the DIA are doing. And if they hold at support, then I think I'm still fine trading to the long side and looking for some established plays. Now, if we do lose lows on IWM, or this area, really, as long as it's above 145, we're fine. Now, if IWM moves all the way down to 145, well, then I think we need to step back and reevaluate because that's a much swifter and sharper pullback than what we really want to see in the markets. And that would be a sign that there is a lot more selling than we probably anticipated. And again, something I want to point out is that this is finally the first time that the bulls are really being tested this year. This is something I've been sort of pointing out and talking about for about a month and a half now, is this idea that ever since the turn of the year, we've had straight buying, and we haven't had any kind of a real pullback, and we haven't really seen how the bulls are going to react once we start to see red candles in the market. Right now, all we've been seeing is this sort of persistent buying where the only fear in the market is the fear of missing out, right? And that brings in a different type of trader than the traders that come in once we start dropping, and then the fear of loss comes into play, which is a totally different type of fear. And there are two different types of traders, and they react differently to these types of environments. And now's when we are finally going to see whether the bulls are willing to trust the previous price levels and are going to start buying at what should be support levels rather than sort of backing off and hiding and waiting for somebody else to buy first, right? And so I think we're finally going to start getting them tested, and that's a good sign. Now, again, you can see across the board we're in pretty different spots depending on which index you're looking at, right? Because, again, IWM kind of already lost that first level of support, and they're already breaking down, and they're coming down to the second level. Very different from what we're seeing on the S&P 500, which is still sort of at that first level. You have the NASDAQ, which at this point hasn't even established that level. It's still sort of trading. I mean, you can even just sort of reappropriate these lines and say it's still trading in an ascending wedge. And then we have the Dow Jones, which is starting to lose that level as well, although it's not as clear, right? So a couple of different points of view depending on what you're looking at. Now, looking at these again, if you are looking for equities, well, keep an eye out on some of the major tech names, as they might be behaving better just based off of where the relative strength is across these four indices, right? And what we want to see now is, again, or at least what I want to see is, I want to see these pullbacks be orderly, not be really messy, not be really volatile. What I want to see now is we come down to the support levels we're supposed to, and we establish clean patterns that are easy to trade off of. And I think if that happens, we should see much better trading opportunities across the board. All right, let's take a quick look at the U.S. dollar. We'll look at gold and silver and oil, and then we'll get to the chart requests. Ray, I see you have two requests right now. We'll take a look at both of those. All right, the U.S. dollar. So the U.S. dollar has been very strong over the last week, right? Again, this is something we were looking at last week. We pointed out, right? We had a little bit of erosion in price action. It was trending up nicely, and then it sort of started to break down, and then it established a new range around 25.60, 25, and then we had that nice little breakout over the beginning and mid of February, and it was starting to establish again that it came back down and it was starting to look like it was getting set up for a bounce, or possibly a move back down to the bottom of the channel. I think that's what we established last week, was either we were going to get a bounce play around 25.60 or at the bottom of the channel. Ultimately, what we got was a bounce at 25.60. It was a pretty clean pattern to trade and had a nice move up. So again, if any of you guys are dollar bulls, there was a nice play here. And I think the nice play manifested itself very clearly on the U.S. Canadian, which we'll look at in a second. But before we do that, if we look at the euro versus the U.S. dollar, again, and this is, by the way, this is the pattern that I pointed out earlier, where you have an ascending trend line. Eventually, you break below it, and then you try to bounce back, and you fail as you try to recover that level. And that's what the euro is doing right now. Now, it's pulling back again. Now, remember, this is inverse, right? So up is good for the euro, and down is good. It means the U.S. dollar is doing well. And where we stand again is the euro is still trying desperately to hold this 113, and is starting to lose that. And if we start to break down here, that could be a big move for the U.S. dollar once the euro loses this level. So we still have to keep an eye on this. This is a very critical level, and it's going to have important ramifications on how the U.S. dollar behaves in the near future. For now, the euro is still trying to hold on to that level. But the U.S. dollar is really starting to show signs of strength and looking like it wants to move higher again. If we look at the U.S. versus the Canadian, we had a huge surge up. And it finally sort of established that inverse head and shoulders we looked at. For those that maybe were around a couple of weeks ago, we pointed out, you can see we have a potential inverse head and shoulders that actually ended up manifesting, right? With a big move to the upside. This is a very bullish sign. Again, nice reversal here after it pulled back sharply. And at this point, this is a bullish equity. So the U.S. dollar looks like it wants to continue going higher against the Canadian. And if you miss that play, if you're not a forex trader, the next move would be something like this. Eventually, it'll pull back. It probably won't pull back down there. It'll probably just set up a bull flag, and then from there, it will attempt to clear this 135. Probably needs more work to get there. Needs a little bit more consolidation here, but that would be the next attempted move for it. And if it came all the way back down to 133, that should be a good area to buy as long as it holds and establishes ground there. So that's a very bullish chart for the U.S. dollar right now. If we look at the U.S. versus the yen, this has been a very bullish chart for a few months now, and it continues to stair step higher, and again shows that the U.S. dollar is starting to gain some strength again, which does not bode well for gold, silver, and possibly even oil, although they really haven't shown it yet, or at least too fully. Gold and silver did pull back quite a bit based off of that big surge in the U.S. dollar, and they are at a point now where you can see they're starting to lose momentum and really come down, but they have hit some support levels here, and I'll be curious to see now whether they can still hold the support in the face of a strengthening U.S. dollar. And I think at this point I'd find it harder to trust these guys because, again, the U.S. dollar is just starting to gain a lot more strength. You can see silver didn't hold support, and I think the key area here for silver is it needs to hold above 1390. I'm still not that excited about silver. If I were going to trade a precious metal, I'd still be trading the gold miners rather than silver. But at the moment, I'm really not that excited about either one. And I think SLV still needs some extra work to really establish itself as a longer-term play. And I think swing trading-wise, it's really not worth it. Now, oil's interesting because oil has its own bullish development going on, even despite what we're seeing out of the U.S. dollar and despite what we're seeing out of the U.S. Canadian. And if it can break past this range here, well, then we have a move probably into the mid-60s, all the way to 64, maybe even 65. That would probably happen pretty easily. If we lose this level, then really it needs to lose. If it loses 54, well, then that means that this was a failed breakout, and it probably heads back into the middle of this range around the mid-40s. So kind of a key area here. I think this is still pretty bullish, and I think oil still wants to go higher. And I think oil names in general, if you are looking at them, are probably mimicking this and should be setting up and at the bottom of these little bull flags here and should be setting up for decent plays to the upside as long as they don't lose this level. So that, I mean, at the very least, they're clear trades because you know exactly where to stop out. So oil names is another area that you might want to start screening and looking for potential trades. You know, right now, to me, it looks like maybe tech and oil are two places that look decent as far as looking for some potential trades to the long side in the next couple of weeks. And that covers it as far as the U.S. dollar and the commodities and the markets in general. We have a good 20-25 minutes left for chart requests. So again, those of you that are in here, we got a nice amount of you guys in here. Feel free to put in a chart. Denise, nice to see you in here. I haven't seen you, I think, in a couple of weeks. And Tyler, good to see you in here as well. Hopefully you are learning some good stuff here. Let's take a look. All right. Oh, boy, Ray. So, Ray, I would imagine after your last attempt at trading these triple leverage funds with the gold one, that you would have stopped trading these things. Why are you trading this? Are you day trading it? I hope you're not trading this as a swing trade or as a long trade. For those that maybe are new here, this is a triple leverage fund. It's a short fund. It's based off of what is this one off of, Ray? Technology. So is this off the NASDAQ? What are you trying to do with this? You're long at 18, which means you're short the NASDAQ. Is that correct? All right. Are you trying to day trade this, or is this a swing trade? All right. So I would hope you don't get stuck in the same situation you had with that gold one. I can't remember the name of it right now. I don't know if it was Nugget. where you ended up holding it for months. I personally would not be too excited about this trade. And the reason for that, again, is I can understand your idea of shorting here because, again, we're going off of, you're basically trading this, right? And for those maybe aren't, yeah, J Nugget, that's the one. So this is basically, TECS is basically a mirror image of the NASDAQ, but it's triple leverage, which means it moves 3 times as much as you know, the ETF or the index that it's trying to mimic. However, what happens with these is over the long term they decay, and they decay pretty bad, right? You can see this thing never traded at 500 or 600. What happens is every time it comes down to a certain price, they reverse split. And as you can see, over the long run, this thing always goes down, always, right? So when you're buying this to the long side, you are really going against the grain here. Like really going against the grain. I don't think that trading these to the long side is worth it unless you have really good sense of timing and you are really good at well, really, you have to be really good at timing and you have to have really good discipline as a trader. This is really not something that, I mean, unless you're a professional, this is something that you're putting yourself at a spot where you're more likely to fail. Frank and I had this discussion last week. I'm going to go over it again, just to point out for those of you that are wondering why I'm saying this. So, when you trade a stock, you have 2 ways of basically you lose money if it goes against you, and it goes in your favor, then you do good, right? However, you don't have to worry about time, right? You just, as long as the stock goes up, you're good. If it goes down, you're bad. But if it goes sideways, you're fine. If you're trading options, all of a sudden time comes into play, right? And this is one of the things that I have whenever I try to mentor traders about options, is that if you're using options, you probably don't want to just use them directionally, because all of a sudden you're adding a third variable to your trades, and that's time. The longer you hold an option, the more value it loses, right? And what happens is these triple leverage funds behave the same as options. The longer you hold a triple leverage fund, the more likely that it's going to go against you because it decays naturally, right? So now what Ray's doing here is he wants to short the market, but he's adding a third variable. Not only is he going to be wrong if it goes against him, he's going to be wrong if it doesn't move, because the longer he holds that, the more it's going to decay and move against him anyway. So now, instead of just having a 50-50 chance, it's almost like he has a 30% chance, because if it doesn't move, it's going to decay and it's going to go down, right? So he's lowering his probability of success dramatically. Now, the benefit, or the reason he's doing that is because this thing is very volatile, and so he's hoping it moves up fast enough in order to pay off for him, right? So to go back, in these types of triple leverage funds, it doesn't make sense to put trend lines on them. What you want to do is look at what they are based off of and use those trend lines. So again, we're looking at the NASDAQ. We already did quite a bit of analysis on the NASDAQ. So what Ray's betting on is that we're going to break down here. However, for that to pay off, Ray, for you to get your targets, 1870, 1915, and 2047, likely means that the NASDAQ is going to have to slice through its 200-day, its 20-day, and come down to this level, at least to get to your final targets. That may happen, but there's a decent chance that it only does this, at which point you might only get your first target. Okay? So, to go back here, again, and if you look at it, instead of the ascending channel, it's the descending channel. Here's the breakdown that we had in the markets at the end of the year, right? If you really visualize it, you can see it upside down, right? Here's the wedge, right? and here's the what is support on the Qs and what's resistance on this chart, right? So what you're hoping for, again, by your target of 2047, is you're hoping for a move back to the top of this descending wedge, which would be the bottom of the rising wedge on the Qs. That might happen, but I think more likely than not, what we're going to get is a move to about here. So just keep that in mind. And again, because of the way this behaves, you need to make sure that you don't hold this too long. I know you have a tendency to marry these trades and hold them longer than they're supposed to. I personally, I know you guys come in here for advice, and I tend to try to see the best of each trade, but this kind of goes in the face of a lot of what I just pointed out today. Like I said earlier, even though I think the market is going to pull back, I don't think shorting the market's the best trade. So I personally wouldn't trade this. I wouldn't take this trade that you're looking at. I think that we're better off waiting for a long trade. Which in this case, I think I'd rather watch for this thing to move up and then try to short it and take advantage of the downward momentum that these types of things take. But that's what I'm, so personally, I don't think I could get behind this trade too much. But if you did, just make sure you have a fast stop on it if it starts to pull back or if it starts to take too much time, okay? Now, you sold a call on Tandem. Now, can I ask, are you holding this? Or... because I know we've had this discussion before. You wanted to get long this, you never did. It set up a really nice pattern and became a really good long trade. It doubled in price from 30 to 65. So now, you just placed what 2 days ago? The long play or you sold the call? So what I'm asking is, are you selling a call against the long play, or are you just selling a call for no reason? So you sold a call to collect premium, but you don't have any long play associated with it? You're just selling premium on this? All right, so now, again, Ray, I hate to pick on you, but this is a name that you've been in love with for a long time. It's done nothing. It's gone up in the last year. It's gone up from $2 to $70. Right? So it's gone from $2 all the way to $70, right? And you never bought it, or you maybe you did buy it earlier, but you've had trouble buying it, and now you're trying to short it. I don't really understand your rationale for it. Is this at resistance? Is it possible it pulls back here? Yeah, if you were long this, I'd say selling calls is a decent idea to go ahead and get extra premium out of it. But in reality, this is a bullish pattern. What you're doing here is it had earnings reports, so you're looking for the quick drop. Okay. What's happening here is you're putting yourself in a position where you could collect premium here, right? And it could work out. And you're saying it's like a day trade. If you wanted to day trade it, you should day trade it. If you're looking for the gap fill, selling calls is not the right idea. And this is part of what we were going through with the mentoring. But you weren't consistent enough to stick around. When and this is so, guys, for anybody that's here, he's trying to collect premium here, and he's looking for a gap fill. I'm kind of against the idea of shorting this to begin with, but if you were to short this, if you're looking for a move down, you're much better off buying puts. You're much better off trying to short the stock rather than selling a call. When you're selling a call, you have the market in okay, so in this case, he does have time on his side, right? This is the opposite of what we were talking about with the triple leverage fund. Options tend to decay and lose value over time. And what ends up happening in these sorts of scenarios is if you sell a call, it works more often than not, right? And so, like you just mentioned, you have 50% profit on it, which is great, right? You're doing pretty good right now. The problem is you're putting yourself at risk if this thing breaks back out. Because remember, it's not all about what you're making, right? Um, right. So that's what you just realized. Ah, yes, never short a naked call. You remember now. So, oh, you're looking for 50%. You're not even up 50%. So here's the thing, Ray. Structurally, you're putting yourself at a position where if this trade goes against you, you're going to get hit hard, right? This is a stock that, again, it doubled in price just this year. From January to March, it doubled. It went from $30 to $60, right? You decided to go ahead and short this. And what? So for those of you guys that maybe are unaware, I don't know if he just has one call, but basically he's shorting 100 shares of this, right? And if it goes above, which one did you use? 65? 65. So if this thing goes above 65, if it goes to $70, which is just the top of this range, he's in the hole for $500 per option, negative, right? And all that to collect. What did you sell the call for? So he's exposing himself to a ton of risk just to collect premium on one call. Now, if you thought this was going to pull back, then you're better, especially if you think it's a gap fill, you're better off trying to short the shares or buy the puts. So you're trying to collect so basically you're trying to collect $700, right? And it might work in your favor. Well, actually, you said you're trying to collect half of that, right? So you're looking at risking. You're trying to risk at least $500 to collect maybe $300 or $400, $700 if you get the full amount, and you might get the full amount. But that doesn't make it a good trade. And the reason it doesn't make it a good trade is because, again, you're putting yourself at risk unnecessarily. Selling calls is a great strategy if you own the stock already. And the reason for that is if you bought this at $30 and it went up to $60, then you've already made a great investment. And if you sold the call, if you ever got exercise, it wouldn't actually put you in a negative position. It would just take the shares that you bought and it would just be closing out your trade. But the fact that you're just selling a call outright without having any kind of protection on it means that what you've done right now is you've taken a short position on a trade that again, this thing has just been climbing steadily. And so instead of trying to go to the long side, which is what you've wanted to do for the last year, you ended up going short just to try to get a real small amount of money rather than waiting for the long plays. And you had plenty of opportunities to play to the long side. You could have bought this at 31. You could have bought it as it broke 43. You could have bought it as it started to break out past 49. And you're trying to short it here. And I'm not saying your sold call is not going to work. I'm just saying that you need to understand what you are risking for what you are trying to get out of it. Okay? So keep an eye on it, and make sure that you are, again, the same as your inverse trade. Make sure that you stop out quickly if this goes against you. Okay. All right. So I hope this didn't scare anybody else from putting in a chart request. I normally am not this negative on trades, but Ray's someone I've mentored in the past, and Ray has a hard time following advice. So I have to sometimes make sure that I really tell him what's going on. He has a tendency to really get himself into trouble. We still have a good 5, 6, 7 minutes. Any other chart that someone else is looking at? Wes, I don't know if I can't remember. I know we talked about it, but did you find you closed out all of Intel, right? This thing has done really well. Not sure what else you're looking. I can't remember the other trades you asked me about. You closed it out. Okay, it worked out really great, though. I'm glad that you. So you're in OSB now. Yeah, that's right. You asked me about OSB. All right. Well, it's starting to come up off of that level, right? You'd bought that hammer candle at the end of February, and it's slowly climbing its way back up. I still think it looks good. I think that there's a pretty good chance it gets back to 29. Now, it did have I can't remember this is. I don't think I emailed you this one, but I would probably take partial profits once it gets to 27 or so, and then from there hope for the move back up to 29. It's doing a decent job of bouncing here, and I do like this. Is okay. So it lost this momentum, but it still set up a new pivot higher than the previous one. So there's still a little bit of an uptrend here, and it's still slowly trying to climb its way out, but it's still trying to make a base here. But I'd watch. This is what I'd watch on that and see what happens. But it's doing a decent job here of trying to continue to climb higher. So Ray, you also want Freeport McMahon or FCX to go up. You can see I was looking at FCX, and this actually looks pretty good right here. Not yet, but it's starting to. This looks like a good spot. So we had this nice level of resistance around 1250, and you can see it bumped up against it a few times, and then it finally broke out, and now it's coming back for a retest. And you can see the last 2 days there was a lot of buying at the end of the day, right? So these are the hammers that you want to see, right? You want to see them on a move down into support, and we'll zoom in for that, right? So we've got 2 days now that it came down to 1250 and there was buying. Now, of course, we need to see buying again today, right? Today it's starting to, again, negating those candles, and there is a chance that we lose that level. But I think we're starting to reach a point where this could be setting up for a long play once it gets back above those two hammers. So I think once this thing gets above 1280 or so, that's actually a pretty decent long setup. Although I'd only be looking for a move back up to the previous highs, maybe around the 200 period. But that looks like a decent spot to look at it. So this one looks okay. And I kind of like what I'm seeing out of that. All right, guys. I think that covers it for today. We went over a few charts, and Ray gave us a lot to talk about. All right, one more for Wes. Ray, thank you, by the way. I know, even though I felt negative, but believe it or not, it teaches not just you, but it teaches a lot of people when I point out what I've seen on these trades, and it's not always, even if it's not always positive, there's a lot that we can learn from looking at these trades. So glad you're sharing them. All right, Houston Wire and Cable. So another hammer you were looking at this morning. All right, so let's take. I've never looked at this one. Let's look at the weekly first. All right, so, and these ads are really getting rough. All right, so there's a few levels here. The floor is kind of tough to really define, but I'd say it's something like this, like $5, right? Well, matter of fact, we'll just put it right at 5 because it's a big round number. A lot of buying back and forth through there, but the other key level is here. Around 6 and change, around 620. And you can see a couple things here. We had this breakout here, right, which lines up very, very closely with the price that it's having now, right, which is the what it's dealing with around 580. But we're not going to keep that trend line there. I just want to point out that it kind of went back and forth from 5 to about 620. And the next level would be around 730 or 720, actually all the way up to 770. Matter of fact, that's what I'd do. I'd say this is the real clear trend line. Right, so we've got some price levels to look at, but there is this point right around 580 where it's had some issues. If we go to the daily chart now, I'm going to get rid of that trend line at 580. It's not really necessary, but so these are the price points that we need to really be watching on it. And it's starting to come back down. Now, it has a nice hammer, but I don't think this hammer's enough for me to want to buy yet. I'd like to see either a move past the hammer tomorrow or some kind of a bear flag that resolves to the upside. Just because there is still room back to 5. And while it would be nice for this to establish kind of a move up, this is sort of like what we just pointed out on OBS, right? It already had the established move up and it broke it. So now we're looking for a secondary move back to that price where we get a higher pivot, but I don't think that higher pivot has been established yet. It was OBS, right, or OSB? OSB, sorry. With OSB, it's already been established. Right? We've got the same thing, but we already have the hammer with candles that pushed past it, right? And keep in mind, by the way, like I am bullish. I think this is looking good, but at this point, it does still have some work to do, because at this point, this could still be like a little bit of a bear flag, right? And that's what we got to watch now on. That's what we got to watch now on HWCC, is the same thing, right? Because we already had this established trend that broke. For this to play to the long side, it'll probably do something similar. And what we'd want to see is, instead of a bear flag that resolves down, we'd want to see it turn into a move back up off a failed move. And then that way we could get a move back up to 620 and 650, and then maybe all the way back. But I mean, 770 is kind of a pipe dream right now, but you can get a move back into this area at the very least. But I think it still has some work to do to get there. So we definitely want to see some more structure out of this. But it's obvious you're looking at a lot of similar stuff, right? Because these patterns are pretty similar, so you probably got on the same screen. This wasn't as clear to you, just something that caught your eye on your screener. Yeah, and I'm assuming it's the same screener that caught OSB, just judging by the price action. It's very similar behavior. That's something, by the way, it becomes important for traders, is a skill you should work on is not just, obviously, all traders learn what a ascending triangle is, what a cup and handle is, and stuff like that. But another sort of pattern recognition that becomes important is seeing that these patterns, that a lot of charts develop very similar price patterns or behaviors. So it's important for you to spot them as quickly as you can, because when you see a bunch of names doing the same thing, it's usually the market is doing something, and there's a lot of names that are following the same pattern, but it's not always that case. And so it's good if you can recognize patterns that are similar across the board, whether it's a certain industry or a certain type of name. And that way, if you see certain names start to behave bullishly off of these patterns, you can expect other names that are mimicking that to probably follow suit and do the same thing. All right, Ray, do I have time to explain the stop limit order where you need two? What do you mean by two values? So I think what you're mentioning, so like, let's say if I wanted to buy this, right, I could put a buy with a stop, right? Because I'm setting up an order saying that I'm to buy it when it goes up to that level, not when it trades down, right? So stop limit as opposed to stop market just means to fill it at that price instead of when it gets to that price to set up a market. Okay, so if you're doing it off of an option, or if you're doing it off, if you have a stop limit and it moves past it, it won't fill it. In that case, you need a stop market. The problem with that is if you use a stop market, it will fill you at the market, and sometimes, especially at the open, that could be some pretty bad prices. Okay. More often than not, I just use stop limits, and if there's a gap against me, then either way, I probably want to try to manage that trade during the day. So I typically use stop limits, not stop market. Okay. But the issue you have with that is if you do get a gap past it, then it's not going to get filled. Hope that helps. If not, email me and I could try to give you a better explanation. Okay? All right, guys. That covers it for today. I want to thank you guys that attended, and especially thank you guys that participated. If you guys have any other questions, you can email me, stockdarts@gmail.com, or you can find me on Twitter, or you can find me on the Discord, and just ask. I'm always, even if you don't see me talking on the Discord, I'm usually there, and if you message me or if you ask me in the Discord, I'm more often than not can answer you pretty quickly. Other than that, let's have a good rest of this week. Let's see what the market does. Hopefully it sets up for a nice buy the dip opportunity for us, and we will see each other again next Wednesday.